It seems as though globally that the growth approach to investing is not in fashion at the moment, with the majority of active investment managers choosing to describe themselves as value managers. So is there still a case for growth investing as popularized by Philip Fisher and Peter Lynch? Don Huber, the portfolio manager of the Templeton Global Growth Fund, joins us in studio to share his insights. Well, let's start right there. In terms of growth investing, is it out of fashion and a clear move to value, or is growth just perhaps not making the headlines as much as value at the moment?
I think, thank you for the question. I think, growth investing on the global landscape is one that I think has been under-owned for a number of years. Many of the largest, most well-known global managers are more value managers, and we see that not only here in South Africa and managers addressing the market here, but managers addressing the market either for global investing or international investing in a number of regions. And so I think, as investors are thinking about their portfolio and thinking about diversification within a portfolio, which a number of investors understand, one of the natural areas for them to be looking at is diversifying their global holdings or their international holdings and including a growth component.
Donald, because it's so underrepresented in South Africa, we obviously just wanted you to make the distinction for us or define exactly what it means to be a growth investor. Many of us are familiar with Buffett and Graham and Dodds and the concept behind finding cheap companies, but tell us a little bit about what it means to be a growth investor and how you take it into your approach.
Okay, well, growth investing, kind of pure and simple, the easiest or the most basic answer is that we're looking for faster growing companies as opposed to a value investor who's looking for inexpensive companies. But within global investing, growth investing, there are a number of different varieties or a number of different ways that investors can approach the market. We have a very focused approach within our firm. We are looking for high quality growth companies that we can own for a number of years. So these aren't necessarily momentum companies. These are companies that have a demonstrated track record, demonstrated history of showing above average growth, and an ability through our research, we think, to continue growing for a number of years.
So just looking, would the consumer be a big underpin in the growth story?
The consumer is a big aspect for a number of growth investors, and I think that whether it's a number of expanded opportunities that are available to consumers, new product sets, consumer electronics, companies like Apple or online retailers that are benefiting from selling to consumers, or the rising living standards of consumers in a number of emerging markets around the world. I think they offer attractive opportunities for a number of companies.
Donald, just to take that a little bit further, does it often mean that you're looking for companies that are very dominant in their sectors or their industries around the world? Or, can you categorize it? I think Peter Lynch was very big on choosing companies that were quite small and had the opportunity to grow. How does it sort of fit into the portfolio?
We do look for companies that have a major competitive advantage. I think of it as a durable competitive advantage for a number of years. And so typically these are either leaders in their industries or second or third players where there's a clear competitive advantage that in our view is repeatable and will continue for a number of years.
So let's now move to geographies that you are excited about at the moment. We've heard much about emerging markets and the growth opportunities that rest in those territories. Is the bulk of your portfolio aligned to emerging markets, or do you still pursue the developed environment?
We pursue both developed and emerging markets, and emerging markets through both direct emerging markets investments when we find them and when they fit into the strategy, as well as through developed markets companies that see a tremendous opportunity expanding their product set and taking their products to emerging markets.
So it's obviously businesses that seem to have the opportunity to scale up quite easily without requiring too much further capital investment.
It varies, but we do favor and tend to look for companies that require less capital intensity. An asset-light business is a really wonderful business in terms of generating strong cash flow and strong shareholder returns. But for some of these businesses, clearly it takes a major investment in building out an emerging markets presence. And depending on the nature of the business, the cash flow generation of the entire company, broadly speaking, the ability to fund that investment internally, all factor into our decision on a company.
I see from your monthly note that you are not overly negative on the US and Europe. Obviously, we've seen that traction coming out of the US, a couple of surprises here and there, but there's still the quantitative easing strategy. It has yet to yield sustainable growth. And Europe, you're not too overly concerned about either.
Well, clearly we recognize, and let me back up and say, coming out of the global financial crisis, I think we, in terms of the expectations we were building in for our companies, we recognized that it was going to be a long, slow, bumpy recovery. And so while we don't have a macro component to what we do at the company level, we had, I think, fairly realistic expectations of the pace of growth. And I think broadly speaking, we're still in the midst of that. The US is showing fairly steady growth, although at a fairly low rate, continuing to deal with a number of fiscal issues and political issues, and likely will for the foreseeable future. Europe, clearly in a recession, and at the pace, given the current environment, likely to continue, from a cyclical standpoint, to continue to be challenged for some time. But that doesn't mean that you can't find companies that have either an attractive product set that they're selling into these markets, or companies based in these markets, a European company that's really a global business and benefiting from growth throughout the world.
Don, just to ask you a little bit about, while the macro thinking doesn't come into it, obviously your mandate is to run a global growth portfolio. Just what are some of the filters and metrics you look for across stocks? I mean, if you're looking across the world, obviously there's thousands of companies that you'd need to screen and check, and you obviously have the infrastructure and the resources at Franklin Templeton to do a lot of that. But what are some of the ways you just try and narrow that list down out of the thousands of stocks that you could possibly be looking at?
Well, we think of the characteristics that we look for, the lenses through which every company needs to pass, as growth, quality, and valuation, which I recognize are wonderful words, but they have very specific meaning for us. From a growth standpoint, we're looking for strong free cash flow generation, an ability for a company to reinvest in its business to support the growth, sustainable business models that come from that cash flow generation, and a durable competitive advantage. From a quality standpoint, we're very focused on shareholder returns. And so management that not only can execute and run their business and meet their objectives, but also management that has a focus on the returns that we are earning and that our investors are earning. Visibility, transparency, corporate governance, very important for us. And then valuation. From a valuation standpoint, we want to make sure what we're paying for companies is reasonable or acceptable given our growth parameters. So we look at cash flow generation, availability coming out to shareholders.
The value investors use the margin of safety approach, where they kind of get to a fair value of what they think a company is and then lop off about 30%, or it varies, but they take off quite a big amount to get to a price that they'd be very comfortable with, considering that things can go wrong and that calculations can vary based on your outlook. Do you apply the same sort of conservatism when you look at a stock? Because it sounds to me that growth investing is very much about looking at the future potential of what a company is going to do, as opposed to what you're getting right here and now for it.
I agree with you that we are very focused on the growth potential and on our expectations for what a company should be able to generate in terms of cash flow over a number of years. And so that's our main focus, is making sure that the company is operating in the right environment, has the type of business model that we think should be successful over time. That's the driver for what we do. But we do use valuation as a check. You want to make sure that what you're paying for a company is reasonable given your growth expectations. And you want to make sure that you've considered all different possible outcomes as you're doing your modeling and as you're looking at the valuation.
You sold yet, Bronwyn?
Well, I want to delve into a couple of the stocks that you hold in the portfolio, and perhaps just starting with Informatica Corp. And I think when we go into these stocks, it'll give more color to exactly where you are deploying money at the moment.
Informatica is a US software company. They are involved in providing data integration software. So as you think about businesses that are growing and expanding globally and businesses that are moving some of their resources to cloud computing or companies like Salesforce.com, there's a need for those businesses to pull all their information together and make sure that the information is consistent and do it in a way that businesses can run and make investment decisions within their businesses based on all this information. And so Informatica's specialty is providing software that can bring together data from all of these different databases to help companies run their business. They're considered kind of the Swiss provider of, although they're a US company, but the Swiss provider in that they don't have a database system that they're selling themselves as opposed to Oracle or IBM. They're able to work with all of the databases.
So they're obviously very involved in what many would consider a long-term trend, in that the move to cloud computing is going to, I guess, unroll over the next 5 to 10 years. But you talk about dominance. Are they a dominant company in that space?
They are a dominant company in that space. They have a very strong market share and have been very successful in going up against some of their competitors when they have new opportunities.
We wanted to ask, Don came out here the last time and we had a discussion about Apple, so I think this is probably a good opportunity to take that up again. When we last spoke, Don, Apple was still run by Steve Jobs, although obviously he had his medical condition that had forced him into absence for periods. And you talked about being comfortable owning Apple for at least 2 years, because I asked you if Steve Jobs would die, would you still be invested in Apple? And you said, well, you think there's about 2 years worth of products in the pipeline at Apple that would make you comfortable holding Apple even post Jobs' death. And now obviously we're a year past that situation, that sad situation. So I wanted to come back and ask you, how does the thesis hold in Apple? Because it still is one of your top 10 biggest holdings in the portfolio at the moment.
It's still in the portfolio, and our investment rationale for Apple really hasn't changed over time. We think they are a highly innovative company. As I mentioned to you back then, I think the innovation went deeper and now clearly goes deeper than just Steve Jobs in terms of building out the company. I think there are some underappreciated aspects to Apple that make their success repeatable and able to continue over time. The fact that they're both a hardware and a software developer, I think, is underappreciated. It's one of the reasons they're able to develop such cool products with such a great user interface is because they're developing a very clearly defined set of products, and they manage and own the hardware and the software components. Owning the software component also means higher margins. They're not paying anyone else for an operating system. And I think what is underappreciated by investors at this point is the stickiness of the customer base, or at least what we perceive of stickiness and expect to see stickiness going forward. You know, once you own an iPhone and you have all of your data on the phone, in your photos in iPhoto and your contacts there, and your data in apps that you may have downloaded to the iPhone, statistics show us, and consumer intention surveys show us, that you're more likely to buy another iPhone, and owners of iPhones are more likely to buy another iPhone than owners of any other brand. So I think it's a very repeatable business. Clearly they need to continue to innovate. They need to expand the product set. They're very closed-mouthed about what they do to penetrate different aspects of the market that they're not in. But I think given their history, given their development and their track record, we continue to expect attractive growth from them.